Right, it's 10 o'clock. I shall begin. Good morning, everybody. This is a It's Settled by Credit webinar about how UK manufacturers can improve their cash flow. There is a Q&A option if anybody wants to put a question in, and I'll look to answer that as quickly as possible once I've gone through the initial sort of presentation on that side of things. So I'll make a start. So our agenda for today is discussing why 2026 feels different, what we're seeing in the market, the warning signs to look out for, what lenders are really watching at the present time, a manufacturing case study, and some practical ways to improve cash flow and reduce DSO. So who am I? Glen Morgan, founder of Credit and It's Settled. We're specialists in working capital improvements, order to cash optimization, and cash flow performance. I'm a specialist member of the Institute for Turnaround, a fellow of the Chartered Institute of Credit Management. We are associate members of UK Finance. And several years ago, I was an advisor to the parliamentary review, which fed into the government on late payments. Some of you may know that they recently changed some of the legislation. Whether it works or not remains to be seen, but there is quite a focus on late payment in the UK, at least at government level at the moment. So our mission is to make sure that no business fails just because they struggle to get paid on time every time. So the Settled and Credit team, which is combined, has over 250 years experience. There's some of them sat around a table in the picture. And we've either got credit management or invoice finance experience. We've helped recover over £1 billion for clients since 2009. And when we get involved in projects for businesses, and manufacturing being one of the top ones that we've been involved in recently, there's a typical 20 to 30 day reduction in day sales outstanding, DSO, after our involvement. So, sorry, this is a big long list of horrible things that manufacturing companies are having to deal with at the moment, but the pressure really has intensified. You've got increased employer costs, both with the NI increase and minimum wage. Energy price volatility. We're seeing people go for renewals of their energy contract and sometimes being quoted 150, 160% of the previous costs. Margin compression. Customers are paying slower. There's research showing that it's the worst it's been in 5 years. Delayed investment decisions simply because money is tied up elsewhere. Increased lender scrutiny. Lenders are looking at the viability of the business in a number of different ways. The unpredictability in the supply chain, freight and logistics disruption, growing reporting pressure, and geopolitical events such as wars and certain straits where freight comes from being closed for periods of time. The list goes on and on. Not really seen it ever have this many pressures on businesses in particular. And like I said, every single one of these is very focused on the manufacturing industry. So what we're seeing, customer payments are slowing. Like I said, 5 years, it's got worse and worse. Government changes and everything like that. Whether it works or not, who knows? But at the moment, they are very much slowing. Queries taking longer to resolve. Finance teams stretched. Increased lender scrutiny. Cash flow becoming less predictable, and more management time spent firefighting. So many businesses that we see are protecting customer relationships at the expense of working capital. And what we mean by that is that they don't want to chase their customers because they're worried they might offend them. They are taking longer to resolve queries. They're doing everything they can to keep the customer relationship at the forefront. But sometimes, quite often, that is at the expense of them, maximizing their working capital, which they desperately need at the moment. So how the operational pressure reaches their cash flow. You've got queries unresolved for far too long. Ownership then of that becomes unclear. Collections become reactive. And what we mean by that is it's already overdue. And then you're sort of really quite desperate for the money, so you're chasing it in. DSO then rises gradually. The cash flow pressure builds on the business. And therefore lenders start looking at it and going, well, what are you doing? What do they need to measure, and what needs to get back on track? So operational stress often appears quite a long time before financial distress, and it can gradually build over a period of time to cause issues. So a health check for your business is looking at your average DSO or debtor days, looking at your typical 90-day plus debt percentage. It should always be ideally less than 5%, but anything up to and around 10% plus is very much a concern. How quickly do you resolve queries? Are they real queries? Are your customers just taking the mickey? Are they, giving you queries to resolve, knowing that it will take time for you to do that, and therefore the cash is tied up for longer? And we always advise businesses to have a weekly cash collection target if they can within their for what they need to feed into their cash flow. So the warning signs to look out for, and like we said, these patterns are appearing 6 to 12 months before cash flow really does become critical. So if your DSO is creeping up month on month, even gradually, even by a few days over a period of time, your age debt report showing that the same customer names repeatedly on there with overdue debt, the collections team spending a lot more time on queries than chasing. They've almost become sort of processing clerks as such. They're not doing that chasing because there are so many disputes to deal with, and the disputes are taking far longer to resolve. A lender is requesting more frequent reporting. They may be auditing things, asking a lot more questions about specific accounts than they previously did. And the finance team is unsure who owns the overdue accounts internally. We see quite often where a director of the business has said, you come to me on this customer. And therefore the finance teams don't feel very empowered to be able to achieve their cash collection targets. And then customer payments slipping from 30 to 45 to 60 days, no escalation, and worrying about it afterwards. Credit limits being stretched without a formal review. Sometimes businesses don't even have credit limits, but we're seeing quite often if they've got a credit insured limit, they'll quite happily go over that because it's a good customer, as they call it. So the danger with each of these is in isolation, they're all completely manageable, but a combination of them starts over time to really signal a problem. So what do debtor days really cost? So in this example, it's a bit of an extreme one, but it is a real one that we helped. So debtors 6 million, annual sales 20 million. The debtor days figure was 110 days. So if we reduce that by 10 days, that's 548,000 of extra cash into the business. By 20 days, still reasonable thing to be able to do. That's 1.1 million, and 30 days would be 1.6 million of extra working capital. And that would still give you a DSO figure of 80 days, which is high. So, with this particular business, the extra cash that could be generated is just phenomenal. So what lenders are really looking for with regards to short-term working capital strain, they're focusing on the DSO deterioration, if it's going up month on month for a period of time, age debt growth, in particular the end column. They start to get nervous about the validity of the whole of the ledger when the end column has got some quite high values in it. What the cash visibility looks like, what the reporting quality, how predictable your business is with regards to when money is likely to come in. And more important than anything, what is the operational control over the ledger? Have they got confidence in the people that are dealing with it, that they know what they're doing and can manage it effectively? So a very quick case study. This is a 45 million turnover food manufacturing business that we helped last year, 6 million invoice finance facility. They'd lost 1.3 million in the last set of financial accounts, and they had 1.5 million tied up in the end column. Over a period of time, we reduced that to 21k over 4 months, and I'll just briefly cover how. So we took over the collections process. We implemented urgent query resolution, which generated a lot of cash very quickly. We produced an accurate rebate accrual to give the invoice finance provider comfort that when offsets were coming in, they were already known about, they were planned for, and they were all part of the facility. We wrote a credit and collections policy and procedures for them and got it implemented, and then made sure that the staff changes that were needed within the department were put in place. That did actually then involve a new CFO having to come in because the previous one was not up to standard. So we were liaising with all the stakeholders, including a turnaround director who'd been appointed by the business's bank as well. And the results, as I mentioned before, the overdue debt down to 21,000 inside 4 months. Some monies needed to be written off, but it did actually generate 1.2 million in additional working capital over that 4-month period. The invoice finance facility, which had been dropped to an 80% prepayment as trust had been lost, was put back up to 90%. So that produced another 600k uplift in working capital for them. New policies and procedures implemented and followed, and the business had the right staff in the right position. Trust regained from the bank and invoice finance provider. That was over a year ago, and everybody's still really, really happy with everything that went on there. So, practical actions for businesses. Improve the visibility across the age debt. Run weekly age debt reports segmented by customer value, days overdue, not just the total balance. Categorize into 30, 60, 90, a standard age debt report with a named owner for each area. Identify your top 10 accounts by value. These typically represent probably 70 to 80% of your exposure. And ask the question, does your finance team know why each overdue account hasn't been paid? Have they got detailed notes? And are they valid reasons, or should further action be being taken? Resolve disputes. We so often see this, that a business has got an end column, which is big. Not much of it is necessarily collectible until some disputes have been resolved. So, working really hard, having a time frame as to when those can be done. I think 10 working days is perfectly reasonable to turn around and say that's when things have to be resolved by. If you spend longer than that resolving disputes, you are inviting some customers, only some, but they will deliberately put disputes in knowing that it ties up cash for a period of time, and they get to use you as a bank then basically while you're resolving it. So if you become really efficient at resolving disputes, you are less likely to have customers giving you untrue queries as such. They'll realize that you resolve them so quickly that there's not actually any benefit to them in putting a query in. Reduce reactive collections activity. So what we mean by that is when it's already overdue, then you start chasing, and sometimes it can be quite aggressive chasing if you've got working capital pressures. But the proactive model is contacting all customers before it's due, just getting some rapport going with them, making sure that you fully understand, making sure that reminders are going out, and that by the time something is overdue, they should only ever be there if there is still a query to resolve and everybody else has paid accordingly. And then measure the ratio of the proactive to reactive contacts in your collection team. If you've got a decent credit controller or credit control team, they should be doing all of this before it becomes your problem. And when we say your problem, obviously, if it's already overdue, then that is your problem. If you're dealing with all of these things before it becomes overdue, then it's a lot better for you. Improve communication. If you've got a lender, if you've got an invoice finance provider in there, then just make sure that they are you're walking any issues into them. If there's any potential breaches that are coming your way, if DSO's deteriorating, they'd like to know if you understand why that is. Make sure that all of your reporting, age debt movement, query resolution, everything is demonstrated from an operational control point of view, that you know what you're doing with it. And like I said, if there's an invoice finance facility, understand which invoices are being excluded from your facility and why, because this is often the first signs that tension could appear. The business that maintains lender trust during difficult periods are the ones with strong, consistent communication, not necessarily the ones with the cleanest numbers. Monitor the DSO and cash conversion weekly. DSO is a lagging indicator, so by the time it moves significantly, the problem has been building for weeks or months. Supplement DSO with a weekly cash conversion tracker. How much cash did you collect this week versus what was due? Set a DSO target and review weekly. A 2 to 3 day movement in a single week is an issue. Share a one-page weekly cash flow dashboard with your senior team, because visibility then drives accountability, and then the accountability should drive the behavior. So some key takeaways. Working capital pressure is now arriving faster than expected, particularly in the manufacturing sector. Operational issues often drive the age debt. Lenders are focusing heavily on cash visibility. Delayed decisions increase risk. Strong operational control improves resilience. And businesses that act earlier retain so many more options. I've just put up a QR code for anybody who wants to scan that. That will take you through to our working capital health check page, which you can download yourself and complete, or we're more than happy to work through with you as well. It'll give you an indication of where you are as a business, and any issues that you need to address. And yeah, I'm open to anyone who's got any questions now. I can see there's no open questions at the moment, so I will sit tight and see if anybody wants to. Um, but for those listening to the recording afterwards, because I can see that the participants versus how many we've got booked on, there's a bit of a difference in the number. So I'm assuming some people are going to download this later. Please do reach out. Contact details are on here. Like I said, the QR code is there. And yeah, please contact me afterwards. There are my details up on the screen. Confidential sales ledger review. There's the contact details, the website, my LinkedIn, my email address, everything on there. So yeah, please feel free to reach out at any stage. We are here to support UK manufacturing businesses at the moment. And thank you very much to everybody for listening. I will just check one last time for questions, and then sign off. Okay. Thank you very much for listening, everybody. Have a good rest of the day.